Trading charts can initially appear complex and overwhelming. Many individuals find it difficult to understand trading charts at first. The visual representation of data can be confusing for novice traders. Understanding the components of a trading chart is essential. Proper education can help traders overcome this initial confusion. Many individuals discontinue trading activities. A primary factor is insufficient education on market analysis. Inadequate understanding leads to poor decision-making. This lack of knowledge often results in financial losses. Consequently, traders become discouraged and cease participation. This video explains the functionality of financial charts. It will identify the platforms necessary for chart analysis. The video covers basic options related to chart usage. Beginners will learn how to effectively start using charts. The video aims to provide a foundational understanding for chart analysis. Trading charts are visual representations of price movements over time. Traders use charts to identify patterns and trends. Chart analysis helps traders make informed decisions. Understanding charts is crucial for effective trading. A trading chart provides a visual representation. It illustrates the movement of prices over a specific period. The chart is a fundamental tool for traders. It helps to analyze price trends. Market price fluctuations reflect the dynamic interplay between buyers and sellers. Upward price movements indicate stronger buying pressure relative to selling pressure. Conversely, downward price movements suggest stronger selling pressure compared to buying interest. Each price increment or decrement is a manifestation of this competitive balance. Price movement in a market is governed by the balance of buyers and sellers. Dominance of buyers leads to an increase in price. Conversely, dominance of sellers results in a decrease in price. Price fluctuations reflect the relative strength of buying versus selling pressure. The market is characterized by a continuous battle between buyers and sellers. This ongoing conflict creates opportunities for traders. Traders aim to profit from the price fluctuations caused by this battle. Successful trading involves understanding and anticipating these market dynamics. The interaction between buyers and sellers determines market trends. Traders analyze these trends to make informed decisions. Candlestick charts are a popular tool among market traders. They are favored for their effectiveness in market analysis. The preference stems from the visual representation of price movements. This allows traders to quickly identify patterns and trends. Candlesticks are a visual representation of price movements. Each candlestick provides 4 key pieces of information. These data points are the opening price, closing price, highest price, and lowest price. These values are essential for analyzing price trends. Green candles on a price chart indicate a price increase over a specific time frame. The body of the green candle represents the range between the opening and closing prices. The bottom of the candle body shows the opening price for the period. The top of the candle body indicates the closing price for the period. Any shadows or wicks extending from the body represent the high and low prices reached during that period. Therefore, a green candle visually confirms that the closing price was higher than the opening price. Red candles are a visual representation of price movement over a specific time frame. The color red signifies a decrease in price during the chosen period. This indicates that the closing price was lower than the opening price. Therefore, red candles are associated with selling pressure. The length of the candle represents the magnitude of the price decrease. The size of a candle provides insights into the intensity of price fluctuations. Larger candles typically indicate stronger price movements in either direction. Smaller candles suggest weaker or more indecisive price action. Analyzing candle size helps traders gauge market momentum and potential trend strength. Large candlestick patterns are significant indicators in price action analysis. These patterns typically suggest strong momentum in the market. They often reflect decisive buying or selling pressure. Therefore, large candles can signal potential trend continuations or reversals. Small candles in market analysis often indicate a period of market indecision. These candles suggest that neither buyers nor sellers are dominating. The presence of small candles can reflect hesitation among traders. This hesitation may lead to a sideways or range-bound market movement. In trading, support refers to a specific price level. At this price level, a stock or asset's price decrease is expected to halt. Support levels are identified based on historical trading data. These levels suggest a concentration of buyers willing to purchase the asset, preventing further price declines. Resistance is a key concept in technical analysis of financial markets. It refers to a specific price level on a chart. At this level, an asset's price tends to encounter difficulty in rising further. Resistance acts as a ceiling, temporarily halting upward price movement. This phenomenon is often attributed to a concentration of sellers at that price point. Understanding resistance levels is crucial for traders in making informed decisions. Support and resistance levels are key price points on a trading chart. These levels emerge from past interactions between buyers and sellers. Significant buying or selling activity previously occurred at these prices. These past actions create levels where price movement tends to pause or reverse. Price memory refers to the market's tendency to react to previous levels of activity. These levels act as reference points, influencing current trading decisions. The market retains a memory of these price points. Price often reacts when revisiting these remembered areas. This reaction is due to traders anticipating similar activity as before. Professional traders avoid impulsive trading decisions. They strategically wait for prices to reach specific, predetermined levels. This approach contrasts with chasing trades based on immediate market movements. Patience and calculated entry points are key elements of their strategy. A trend indicates the general direction in which a market is moving. Market trends are identified by observing price movements over a period of time. Trends can be upward, bullish, downward, bearish, or sideways. Neutral. Understanding trends is crucial for making informed trading decisions. An uptrend is characterized by a series of successive price movements. Each successive peak, or high, reaches a higher price level than the previous peak. Each successive trough, or low, is also higher than the previous low. This pattern of higher highs and higher lows indicates sustained positive momentum in the market. A downtrend is characterized by a sequence of lower highs and lower lows. Lower highs indicate that each successive peak in price is lower than the previous one. Lower lows signify that each successive trough in price is lower than the one before. This pattern of lower highs and lower lows collectively signals negative momentum in the market. Trading with the trend involves aligning trades with the prevailing market direction. Identifying the trend is crucial for successful trend trading. Trend identification can be performed through technical analysis. Trading in the direction of the trend increases the probability of a profitable outcome. Trend trading aims to capitalize on the momentum of established price movements. Traders should prioritize aligning their strategies with the prevailing market direction. This approach emphasizes adapting to market trends rather than opposing them. Effective trading involves identifying and capitalizing on established market movements. Resisting the market's direction can lead to increased risk and potential losses. Alignment with the market enhances the probability of successful trades. Flexibility and adaptability are crucial for flowing effectively with market dynamics. Volume represents the total number of shares traded within a defined time frame. It can also refer to the number of contracts exchanged during a specific period. Volume is a key indicator of market activity and liquidity. High volume often signals strong interest or conviction in a particular asset. Conversely, low volume may indicate uncertainty or a lack of participation. High trading volume typically indicates significant market interest. It suggests a large number of participants are actively buying and selling. Increased volume can validate the strength of a price trend. High volume often accompanies major market moves or breakouts. It can also signal increased liquidity, making it easier to enter and exit positions. However, high volume alone does not guarantee a specific market direction. Low volume in trading signifies a reduced level of market activity. It suggests that fewer participants are actively buying or selling. This lack of engagement indicates weak interest in the particular asset or market. Low volume can lead to increased price volatility due to thinner order books. It may also suggest a period of consolidation or indecision among investors. Therefore, low volume is generally interpreted as a sign of limited participation and weak conviction. Price and volume are key indicators in market analysis. Significant price movements should ideally be supported by corresponding volume. A price change lacking volume may signal a weak or unsustainable trend. This suggests the price movement may not reflect genuine market interest. Therefore, volume acts as a confirmation tool for price trend. Volume is used by traders to assess the reliability of price trends. Increased volume during a price increase suggests strong buying interest. Conversely, high volume during a price decrease indicates strong selling pressure. Significant volume confirms that a price movement is likely to continue. Low volume during a price movement may signal a potential reversal. Price movements are often analyzed in conjunction with trading volume. Volume indicates the number of shares or contracts traded during a specific period. Price movements accompanied by high volume are generally considered more significant. High volume suggests strong conviction and participation behind the price change, making it more reliable. Effective trading necessitates the use of specific tools and resources. A brokerage account is a fundamental requirement for engaging in trading activities. This account serves as the gateway for buying and selling financial instruments. A charting platform is also essential for analyzing market trends and patterns. Charting platforms provide visual representations of price movements and trading volumes. These tools collectively empower traders to make informed decisions and execute trades efficiently. Brokerage accounts are investment accounts that allow individuals to buy and sell assets. These assets include stocks, bonds, mutual funds, and exchange-traded funds, ETFs. Brokerage accounts are typically offered by brokerage firms. Webull is a brokerage platform known for its commission-free trading and mobile-first approach. Thinkorswim by TD Ameritrade offers advanced trading tools and resources for active traders. Robinhood is another popular platform that provides commission-free trading, particularly appealing to beginner investors. TradingView is a popular charting platform. It provides a wide array of tools for in-depth market analysis. Users can access real-time data and historical charts. The platform supports various asset classes, including stocks, forex, and cryptocurrencies. TradingView is widely used by both novice and experienced traders. Trading platforms provide essential tools for market participants. These platforms offer functionalities that facilitate trading activities. One key function is the ability to view charts, aiding in technical analysis. Platforms also enable traders to place trades directly into the market. Trade placement includes specifying order types, quantities, and price limits. Furthermore, these platforms allow users to track their trading performance over time. Expensive software is not a prerequisite for beginners entering the trading world. New traders can commence their activities without significant upfront investment in software. This accessibility lowers the barrier to entry for individuals interested in trading. Beginners should focus on learning fundamental trading concepts initially. Cost-effective resources and tools are available for initial trading education and practice. Options are a type of contract used in financial markets. These contracts grant the holder a specific right related to an underlying asset. This right is the option to either buy or sell the asset. The transaction can occur at a predetermined price, known as the strike price. Crucially, options provide a right without creating an obligation. The holder can choose whether or not to exercise the option. Call options are financial contracts that give the buyer the right, but not the obligation, to buy an asset at a specified price within a specific time period. The value of a call option is derived from the underlying asset's price. A call option becomes profitable when the market price of the underlying asset rises above the option's strike price, plus the premium paid for the option. The strike price is the price at which the option holder can buy the underlying asset. The premium is the initial cost paid by the buyer to acquire the call option. Therefore, call options are typically used when the investor anticipates an increase in the asset's price. Put options are financial contracts that give the buyer the right, but not the obligation, to sell an asset at a specified price. This right extends until the option's expiration date. The value of a put option increases when the price of the underlying asset decreases. Investors use put options to profit from anticipated declines in asset prices. Put options can also be used as a hedge against potential losses in an investment portfolio. Options trading provides traders with leverage in the market. Leverage allows control over a substantial number of shares. This control is achieved with a relatively small capital outlay. Options amplify potential gains compared to direct stock ownership. However, leverage also magnifies potential losses proportionally. Therefore, risk management is crucial when utilizing options for leverage. Options trading involves a significant degree of risk. Beginners should be aware of the potential for substantial losses. Effective risk management is crucial for navigating options trading. A key strategy is to start with small position sizes. Smaller positions limit the potential financial impact of any single trade. This approach allows beginners to learn and adapt without excessive risk. Professional trade execution involves a series of strategic steps. The first step is identifying the prevailing market trend. Next, locate key support or resistance levels to inform entry and exit points. Finally, set a stop loss to limit potential losses and a profit target to define the trade's objective. Emotional decision-making can negatively impact trading strategies. A structured approach is essential for removing emotions from trading decisions. This helps traders make more rational and objective choices. Emotion removal can lead to improved trading performance. It promotes consistency and discipline in executing trading plan. By minimizing emotional influence, traders can better manage risk. Effective trading relies on executing a meticulously crafted plan. The focus shifts from speculative guesswork to strategic action. A well-defined plan provides a clear roadmap for trading activities. This structured approach minimizes impulsive decisions based on hunches. Successful execution involves adhering to predetermined entry and exit points. Disciplined plan execution enhances consistency and reduces emotional trading errors. Chasing price movements is a common mistake made by beginners. Beginners often react emotionally to short-term price fluctuations. This can lead to impulsive buying at market peaks. It can also cause selling in panic during market dips. Such actions are usually driven by fear and greed. It is important to avoid this behavior. Trading without a well-defined strategy is a common pitfall for beginners. A trading plan provides a structured approach to market participation. Without a plan, decisions are often based on emotion rather than logic. Emotional trading can lead to impulsive and poorly timed actions. Such actions frequently result in financial losses and increased risk. Therefore, developing a clear trading plan is crucial for success. A common mistake for beginners is risking too much capital on a single trade. Over-leveraging can lead to significant financial losses. It's crucial to manage risk effectively. Avoid allocating a disproportionate amount of your capital to any single trading position. Diversification and proper position sizing are key strategies. Protecting your capital should be a priority. Ignoring stop-loss orders is a common mistake among beginner traders. Stop-loss orders are designed to limit potential losses on a trade. Without them, losses can accumulate significantly and unexpectedly. This can lead to substantial financial setbacks for novice investors. Implementing stop-loss orders is crucial for risk management. It helps protect capital and prevents emotional decision-making during market downturns. Successful trading emphasizes patience as a core virtue. Discipline is equally crucial, guiding actions and decisions. Trading rewards those who adhere to a well-thought-out plan. It penalizes impulsive actions driven by emotion or speculation. Therefore, patience and discipline are key to long-term trading success. Learning to trade can be effectively understood through the analogy of learning a new language. Both activities require the acquisition of a new vocabulary and grammar. Success in both trading and language learning depends on consistent practice and immersion. Fluency in trading, like in language, involves understanding nuances and adapting to different contexts. Trading can initially feel overwhelming due to its complexities. New traders often experience confusion when starting. The initial learning curve can be steep and discouraging. Understanding the basics is crucial to overcome this initial confusion. Proper education and guidance can help navigate the complexities of trading. Pattern recognition involves identifying recurring regularities in data. Understanding these patterns reveals underlying principles. Recognizing patterns enhances predictive capabilities. This understanding facilitates informed decision-making processes. Grasping patterns and principles fundamentally transforms perspectives. Consistency is a key factor in achieving success. Consistent study habits reinforce learning and retention. Regular application of knowledge solidifies understanding. Consistent effort builds momentum and progress over time. Success is often the result of sustained, consistent action. Consistent chart analysis is crucial for skill enhancement in trading. Regular study of charts aids in recognizing patterns and trends. Improved pattern recognition leads to better decision-making. Therefore, regular chart analysis is a cornerstone of trading proficiency. Emotional control is a crucial aspect of successful trading. Uncontrolled emotions can lead to impulsive and irrational decisions. Rational trading decisions are essential for maximizing profits and minimizing losses. Emotional discipline helps traders stick to their strategies. It prevents fear and greed from dictating trading actions. Therefore, mastering emotional control is vital for consistent trading performance. Adhering to specific principles can improve a trader's probability of achieving success. These principles act as guidelines for making informed trading decisions. Consistent application of these principles helps manage risks effectively. Ultimately, these practices contribute to a higher likelihood of profitable outcomes in trading. The channel provides educational content on effective trading strategies. Subscribing ensures continuous access to trading knowledge. Effective trading requires ongoing learning and adaptation. Subscription supports the channel's ability to provide valuable content. Continued learning can improve trading skills and outcomes. Trading charts are visual representations of price movements over time. These charts display fluctuations in price for a specific asset. The data is plotted on a graph, showing price changes across a defined period. This allows traders to analyze past price behavior. Ultimately, Traders use this analysis to make informed trading decisions. Candle wicks are visual elements in financial charts. They represent the price range during a specific trading period. The upper wick indicates the highest price reached. The lower wick indicates the lowest price reached. A breakout is identified when the price of an asset moves beyond a defined support level. Alternatively, a breakout can also occur when the price surpasses a resistance level. Support and resistance levels act as key thresholds for price movement. Breakouts often signal a potential shift in market sentiment or trend direction. A range-bound market is characterized by price fluctuations between established support and resistance levels. Support levels represent price points where buying interest is strong enough to prevent further declines. Resistance levels indicate price points where selling pressure is strong enough to halt upward movement. In a range-bound market, the price oscillates within this defined channel. This pattern suggests a lack of a clear trend, either upward or downward. Traders often use strategies to buy near support and sell near resistance in range-bound condition. Order books are electronic lists displaying outstanding buy and sell orders for a specific asset. These orders are categorized by price level, showing the quantity of bids and asks at each price. Buy orders, or bids, represent the prices at which buyers are willing to purchase the asset. Sell orders, or asks, indicate the prices at which sellers are willing to sell the asset. The order book provides a real-time snapshot of supply and demand for the asset. Analyzing the order book helps traders gauge market sentiment and potential price movements. Economic calendars are essential tools for traders and investors. They provide a schedule of upcoming economic events. These calendars also detail the release dates of key economic indicators. This information helps in anticipating market movements. Traders use economic calendars to plan their strategies around these events. Options contracts are agreements that grant the holder the right, but not the obligation, to buy or sell an underlying asset at a specified price on or before a specific date. A key feature of options contracts is that they have specific expiration dates. The expiration date is the date on which the option contract becomes void. After the expiration date, the option holder can no longer exercise their right to buy or sell the underlying asset. Therefore, the expiration date is a critical component of an options contract that determines its lifespan and exercise window. Establishing realistic trading goals is crucial for achieving sustained success in the market. Unrealistic goals can lead to disappointment and poor decision-making. Realistic goals provide a clear roadmap and measurable targets. Achievable objectives help maintain motivation and focus. Setting small, attainable goals builds confidence and momentum. Long-term success in trading depends on consistently meeting realistic expectations. Employing a variety of trading strategies is a method to mitigate potential risks. Diversification across different strategies reduces dependence on any single approach. This approach helps to balance performance during varying market conditions. Ultimately, diversifying trading strategies can lead to more stable and consistent returns. Education is fundamental to grasping the complexities of trading. Proper education provides the necessary tools for informed decision-making. Understanding market dynamics requires a solid educational foundation. Education empowers traders to navigate risks and opportunities effectively. Charts are visual tools used to represent price data over time. These charts can display data across different time frames. Available timeframes range from short durations like minutes to longer durations such as years. Candlestick charts are a visual tool used in financial analysis to represent price movements over time. The body of a candlestick represents the price range between the opening and closing prices for a specific period. If the closing price is higher than the opening price, the body is typically colored green or white, indicating a price increase. Conversely, if the closing price is lower than the opening price, the body is colored red or black, indicating a price decrease. A false breakout is a trading pattern where the price of an asset temporarily exceeds a defined resistance or support level. This movement initially suggests a continuation of the trend in the direction of the breakout. However, unlike a true breakout, the price quickly reverses direction. This reversal traps traders who entered positions, anticipating a sustained move in the breakout direction. False breakouts can occur due to various factors, including low trading volume or market manipulation. Identifying and avoiding false breakouts is crucial for risk management in trading. A consolidating market is characterized by a lack of significant price movement. This state often reflects a period of indecision among investors. Buyers and sellers are in equilibrium, preventing large price swings. Consolidation can occur after a significant uptrend or downtrend, It often represents a pause before the next major price movement. Traders watch for breakouts from consolidation patterns to identify potential opportunities. Market sentiment is the overall attitude of investors toward a specific security or financial market. It represents the feeling or tone of the market. Market sentiment can range from positive, bullish, to negative, bearish. It is often considered a contrarian indicator. Effective risk management is crucial for safeguarding capital. Risk management involves identifying potential threats to financial resources. It also includes assessing the likelihood and impact of these threats. Developing strategies to mitigate or avoid these risks is essential. Proper risk management helps ensure the long-term preservation of capital. Implied volatility is a measure of the expected price fluctuation of an asset. It reflects the market's view of how much an asset's price will move in the future. This expectation is derived from the prices of options contracts on that asset. Higher implied volatility suggests a greater expected price swing, and vice versa. Analyzing past trades is crucial for enhancing future trading performance. Reviewing completed trades provides insights into successful strategies. It also identifies areas where improvements can be made. This analytical process aids in refining trading skills and decision-making.